Hello and a warm welcome. You've joined us on Midcap Masala right here on ET Now. I'm Ashesha Advaryu. You've joined us on our ET Now Suzlon studio. And this is a show where we discuss all the mid-caps that are in focus today. But first up, let's take you through all the top headlines that we're tracking at this hour. RR Kabel rallies after reporting strong earnings beat with robust growth across revenue, profitability and margins. The company also announced that its FMEG business has achieved break-even, marking an important milestone for its consumer products business. And Coforge, meanwhile, is in focus after reporting strong revenue growth that exceeded expectations, driven by continued business momentum. However, margins softened and profit declined sequentially, reflecting higher costs during the quarter gone by. The stock is up a whopping 9% in trade today. Shifting focus to Godfrey Phillips then, the stock is declining in trade, now down 6.5% after reporting weak quarterly performance with a sharp decline in profit and margin contraction. Management said it is following a balanced pricing strategy with price hikes being passed on to consumers in a phased manner. Gallant Ispat, meanwhile, from the metals pack is also in focus and the stock is locked in upper circuit of 5% after reporting its quarterly performance, with profitability meanwhile coming under pressure despite very stable revenue growth that the company reported in the quarter gone by. The stock is up 5% in trade today. Orient Pro Solutions, meanwhile, is trading lower. The stock, in fact, is down more than 11% in trade after reporting muted operational performance as project timing shifts, supply chain disruptions, and geopolitical issues in the Middle East and Africa impacted their revenue conversion. The company also saw margin contraction due to higher input costs during the quarter, and that is exactly why the stock continues to remain under pressure. But shifting focus then, let's put the spotlight on Dodla Dairy. Then this counter reported its numbers, and very strong set of numbers that the company has reported. Although margins have come in weaker as compared to street expectations, and even when we compare on a year-on-year basis, margins have been weaker. But the management, of course, believes that we will see recovery in margins in the next few quarters. To discuss that in greater detail, we are now joined by the managing director of the company, Mr. Sunil Reddy, who is now joining us. Mr. Reddy, thank you so much for taking your time out and joining us here on ET Now. And first of all, congratulations on reporting very strong set of numbers that you've reported for the first quarter. Volume growth has been very strong and the share of revenue from value-added products also aided the numbers. But how much of this volume growth is sustainable in the next few quarters? If you can help us with that number.
Good morning and thank you for having me on your show. Coming to our numbers, I think the volume numbers will not be in terms of this kind of a growth because last quarter-on-quarter comparison, last quarter we had more monsoons during the summer and this year the summers were extended. Therefore, we saw extraordinarily large offtake. But as per our guidance, we are still confident that we will achieve the 10% growth in volume and 15% growth in value for the whole year. This will be with the help of all the three things that we have. That's the new acquisition we have done in the east of India, Africa and India put together. We are very confident we'll achieve this number of 10% volume growth compared to the previous year.
Okay, so 10% volume growth is pretty much achievable in FY27. That's the word coming in. Although the numbers were very good, one concern for the street was margins because they have declined from about 8.2% same time last year to about 5.4% now. And one of the reasons is elevated milk procurement costs and higher packaging, transportation and fuel expenses. How soon could the margins recover and what will the triggers be? Will price hike be one of the reasons?
Yes, ma'am. Predominantly, we were waiting to see if the monsoons would be set in and if will the milk procurement prices come down with higher available milk. But I think the El Nino effect taking place, that doesn't seem like to happen. If it does not happen, we have already started taking corrective action in terms of increasing the passing on the prices to the customer. It is more done in a phased manner and we will recover our margins because we will have to pass on to the customer the increased prices.
Okay, so the margins will recover in the coming quarters and you are telling us that you will be passing on the impact of higher raw material prices. How much will the price hike be? How much price hike have you already taken in the last 1 or 2 months? And how much more will be required to get back to that margin trajectory?
I think we should be taking into consideration, I think our procurement prices actually went up by 10% and we had already taken around 2.5% price increases, done a lot of the corrections. Therefore, our effective EBITDA margin only contracted by 3, although the procurement prices went up significantly. by increasing the prices, we are confident we'll come back to our between the 7 to 8.5% margins that we were in the previous year. We will maintain those margins.
Okay, so by undertaking the price hike, you're telling us that 7 to 8% margin guidance will be maintained. But raw procurement cost, that's the raw material cost for you, has also risen exponentially in the last few months. Do you think that will perhaps normalize in the next few quarters?
That's basically, we were thinking that, and that's why we didn't pass on the prices in the first quarter, saying that if it normalizes, we will continue with the procurement prices. It's very difficult to say. It's like the El Nino that all of us know about, and we are seeing that certain areas the weather has been playing truant and there is a deficiency of rainfall. If that happens, we don't think that the procurement prices will come down, but they will maintain the same levels.
Okay, so procurement prices might maintain at the same level, if not decline. Let's also talk about the value-added product segment, and that is a strong margin accretive business for you. And you also reported very strong growth of 41% on a year-on-year basis as far as the value-added product segment is concerned. How much growth could we expect in the next few quarters for this particular segment?
See, normally we give guidance that overall we will grow by 2%, 3% as an absolute with the revenue that we have. On a quarter-on-quarter basis, the last quarter this year and the last quarter previous year, the difference you see, like I was explaining earlier, last year the quarter was more muted because of monsoons being earlier and the summer not being so severe. And this year the summers being more extended. All our value-added products in terms of the fermented products like lassi, buttermilk, ice creams, and all these have taken a significantly moved up. But we are seeing that they're not dropping down as much as we normally see once the monsoons set in. And if the monsoons continue to be weaker this year, we might see stronger traction in the value-added products going up by 3-4%. But it will be offset by the previous years. We did have a bit of volume of ghee sales, which was this year will be muted. So I think it will net off of that, and we can expect an average of 3 to 4% increase overall in terms of the value added.
Okay, so 3 to 4% increase in the value-added products, but as a percentage of your total pie, value-added products now contribute about 35% of your total sales. How is the mix expected to change going forward? I'm sure you're focusing more on the value-added product segment. Will this 35% then increase gradually, and if yes, how much?
In the years to come, this will increase over the 1-2%, but it will taper off at a point of view because it's as good as what the household views eats the dairy pie. How much of milk is in the dairy pie and respective value-added products like curd, paneer, and the other products coming in. What we are seeing is that the consumption patterns are changing with the protein fat coming in. People are beginning to eat more paneer in the south, and such if any such products take off a little more, then we can see larger percentage of the overall pie. But otherwise, it will be growing in the steady phase of 2 to 3% a year.
Understood. And how much incrementally is the value-added product segment more margin accretive as compared to the other segments? I'm sure margins for value-added products are higher as compared to the other segments. What is the difference?
Basically, milk and what we call as non-milk is the value-added products, which includes dahi as a major earnings. So normally the value accretion should be between 4 to 5% compared to milk.
Okay, let's also talk about your Africa business. I do understand that it's still small as compared to the total consolidated numbers, but it remains a major growth engine driver for you. What is the outlook on the Africa business?
Africa business has always been a very value-added business for us in terms of the return on capital is extremely large and the profitability is also very large. So we are looking at around a 600 crore revenue this year coming from Africa and maintaining a 12 to 15% kind of EBITDA margin in Africa.
Okay, so 600 crore revenue expected from Africa business this year. What about your expansion projects back home in India? I believe you have some in Maharashtra, others in Bihar as well. What are those and what will they be used for?
Maharashtra is basically a balancing plant for us in terms of our procurement, and also we're selling, when we mean Maharashtra, we're extending it from the borders of Hyderabad and going into Maharashtra. So it will be Sholapur and the surrounding areas that we will be selling products like milk, curd and other products that we make. But Maharashtra will also be a large powder facility with 65 tons of powder manufacturing facility available. So we're planning to make Maharashtra a 10 lakh liter per day operation for us. In Bihar, we had acquired Osam Dairy, which had 3 plants, one in Ranchi, one in near Patna, and one in Chandil. We also are trying to revamp the Chandil plant so that it can take on more products like flavored milk and yogurt for the markets there and the surrounding markets, which also enter into West Bengal. That is the thing that we'll be revamping the Chandil plant. And we had also had some land allotted to us. We are now looking at how to make use of that land, whether we should delay that land and use Chandil more than using the land that we have got already allotted to us.
Understood. So that's as far as the capacity expansion plans are concerned, both in Maharashtra as well as Bihar. And the international business, including the Africa business, is doing very well for the company. Thank you for taking your time out and joining us here in ET Now and sharing your thoughts not only for this year, but even with respect to the coming years and the margin outlook for the company. Thank you for joining us today.
Thank you, ma'am.
On that note, we need to slip into a very short break, but more news and updates will continue on the other side, and we'll touch base with the management of Balaji Mines after this.